Welcome to TradeTheNBI.com. This is John. This report is for the 23rd. Well, as you can see, the dip of that magenta below not just the 33, but then when it failed the 25, we just accelerated the move back down to zero. Now, of course, we were talking about this would be a question of whether we would end up with a higher DOC red when it eventually does pivot. Hasn't done so yet, and the shakeout continues to be extremely negative. And we just saw the potential here at the start of today's action dip below the red line. We'll see if that maintains itself. But now you've reached a matching 0 point, and the idea being that if you ended up with a lower low and higher readings, that would be the beginning of the turnaround. Still hasn't taken place at this particular stage, and as long as you have the DOC orange here between cyan and red, you get a continuation. And in this case, since we're moving lower, it's continuation lower. That said, we've been following the not just the fill that we saw there on the S&P of the positive extreme. It was this one on the Nasdaq that was much further away at that. We get the exact numbers. Make sure I've got it right there. It's 14,300. Still a few hundred away from it for the expectation on that fill, and with the NBI white leading and pretty decent spread between the magenta and yellow on the NBI. Should get there, and that would be the expected move. Of course, people are, freaking out, wondering why all this stuff takes place, and it's like, well, we have a pretty clear target. We've always seen it. The first one we looked for was that S&P fell, and when that came in, they had the potential to stabilize that, but of course, world events make that more difficult, and really, treasuries have been the biggest push at this particular point because the Fed has sort of lost control because treasuries are past where the Fed is from a interest rate standpoint, and that's problematic in a lot of different ways. One, the higher rates pull money from the market, and some of this can be attributed to what's going on with Congress and that inability to move anything forward and what that will mean, and just this unrelenting deficit spending that just keeps accelerating and no end in sight, and particularly becomes problematic because you get into that spiral where at what point you just keep sucking material value from the broader public sector, or you're just continuing to print, and if you keep doing that, at some point it breaks. And having created that whole bifurcation in the markets with the conflict between Russia and throwing China in there, and then now we have the broader Middle East crisis. There's plenty on the plate that is negative. Now, within that hyper negative, you actually have to see some negative results, and if that doesn't take place, then it becomes quite the bullish opportunity. However, oil still becomes that number one focus. Is why we look at these various things. As long as it's elevated there, you can expect there's going to be continued inflation. Will it match where treasuries are at this particular point? No, but it's a suggestion that the Fed is going to be forced to continue to hike, even though they're pausing now. And I think the Fed can wait. I don't see that they have to do anything. I think as much as they criticize where Powell is on this, the reality is they've successfully got rates to a normalized level and are not horribly agitated by the being slightly behind on the inflation curve, because again, that overall helps with the currency devaluation. But still up at that 87 with oil, it's not great from a it really more depends, I think, too, on that the acceleration. I mean, you've already been hit with one wave of price increases. You're going to get with a slightly secondary one. How much further that goes, if it abates, and there's some absorption time, but you need 6-8 months, and the events are changing too quickly, and you get one sour move where oil starts to spike, and that's really probably going to be too much. We already see credit tightening. Look at little things like car repossessions and things like that, and the amount of people behind on those. When that starts to accelerate to a certain point, you begin to clearly see, and of course, yield inversions and stuff like that to indicate, recession. But we've seen those indicators pop up slightly before and just haven't followed through, and that's obviously because of the easy money. So that's been able to keep that afloat. From a euro standpoint, surprisingly, still holding up, and I think that there's going to be coordinated central bank activity on a lot of this at this particular stage, and um, zero even worth that, given what Europe's going through. Unlikely to believe that that's the case, but that doesn't stop things from doing counter to what the expectation is, particularly like what we saw in the decline for gold. We knew that it was going to be moving back up. It was just an opportunity to shake out the weak hands and then make the run. And that's where we're at. And outside move has been to Bitcoin in that. Finally, we see a little activity from ETH catching up just a little bit, making a nice little spike move there off the turnaround MBI reading that came in. Still within tough play with the white MBI lead. It kind of mutes it a bit, and that's just a little bit of that differential that we've seen between Bitcoin and ETH. I think overly dramatic. From a 50K standpoint, we can see that this started back, Thursday of last week, actually even before that, when we started getting MBI white leading in most cases, and then spiking significantly every time there was an attempted pop. And the effect of that is exactly what we've seen to this point. So nothing surprising from that standpoint. I know a lot of people are freaking out and thinking the world has come to an end, but it wouldn't be the first time you hear Chicken Little stuff all the time. There are a lot of problems, don't get that confused, but at this particular stage, still within managing. You can see from Friday's action, it was significantly lower. They tried to bounce back to the 50%, kind of a classics, typically what we see from a positive move. You rise up, come back to the 50%, and new buyers come in. In this case, the new sellers took the higher price advantage and drove that even lower. As we opened up into the Monday action, brief pop up, didn't last very long, and here in the European session, yeah. So that's where things currently sit. And again, we're still waiting for significant ground action in Israel and what expectations that will have on escalating all that's taking place. So interesting October. All good from our reading standpoint. So just continue to follow what we've got. And anything new pops up, I will certainly let you know. As always, though, trade well. Have a good one.